Welcome to this edition of Kuvera Insights. My name is Neelabh, and I invite you to listen in to this very interesting discussion on passive funds. At Kuvera, we like passive funds for their easy to understand investment approach and almost universal suitability. Joining us for this conversation is Vikash Wadekar from Axis AMC. By way of a quick background, Vikash joined Axis AMC in April 24 to spearhead the passive funds business. He's responsible for looking at sales, product, as well as fund management in the passive fund space at Axis AMC. Vikash has more than 2 decades of experience in the investment management and distribution space, with prior stints at ILNFS, ING Visa, Benchmark, and Union KBC AMC. Before joining Axis, he played a key role in establishing the passive fund business for Motilal Oswal AMC and led the sales function there. In terms of qualification, Vikash holds a BCom from Mumbai University and a master's in business studies from Pune University. Hi Vikash, welcome and thank you so much for joining this conversation today.
Hi Neelabh, thank you for inviting me today.
Okay, so we'll quickly get into the meat of the matter. At Kuvera, we've always spoken of passives and how they find place in almost all portfolios. And it would be lovely to have your thoughts on this. So why don't we start by understanding what are passive funds, within passives, what are index funds, and how do they generally compare to active funds, which is obviously the opposite of passive.
Right. Yeah. So you actually said it. It's opposite to active funds. Okay. That's what called passive funds. So what's an active fund? Let's understand. There is a fund manager, right? There is a analyst, okay, who actually do research on a particular stock sector, and then they create a portfolio based on theme, based on different ideas, right? And their objective is to generate better returns than the market. Right, that's called an active management. Exactly opposite is passive management, where you don't select stocks, you don't do any particular research, but you base your portfolio based on the market wisdom or what market is talking about, right? And how do you do that when you choose a particular index? Okay, so very popular index like Nifty 50 or Sensex, they're popular indices. Where what do they represent? They represent, say top 50 or top 30 stocks of Indian equity market. Okay, there are different indices also. And why a particular stock comes into that index is based on what market decides, what market is liking, which sectors which are doing good in a particular market. That's automatically gets captured in a particular index. And that is the passive management. You just follow that index, what market is mandating you to do. Market thinks that this particular stock should be in the index, that stock comes in the index, and you just replicate it. So why it is called passive? Because there is no dedicated research, there is no active research in terms of stock sector, balance sheets and all. You just pick a particular index and replicate it. And passive, we have two types of fund: index funds and ETFs. Basically, ETFs, you need a demat account and trading account to buy and sell. Whereas index funds are simple. It's like any other mutual fund. If you have a KYC compliant, you can buy through a website or any app or on your app as well. So that's the passive funds are all about.
Great. Thanks for the description. Sounds to me like this is something shouldn't an investor be able to do this on their own?
Yeah. See, what is an index? There is an index committee which identifies on few parameters why a particular stock would come in, based on its performance, based on its liquidity. Okay, and then the weights are given in the index. Right. There are too many things happen in a particular index. Also, there is something called, you get a lot of dividends. There is a corporate actions happens. Bonuses, splits also happen. Right. And every 6 months there is a rebalance which happens, and it's a new stock come in, and a few stocks which are not now fitting that parameter go out of it. Now to do this and replicate for an individual, it becomes a task. Okay, to do the corporate actions or to in and out. Yes, one time you can do that. You can just replicate a particular index, but to continue to do that, that is also known as a tracking error, which you see how to pick up a particular index fund. That tracking error tells you how closely a fund manager is able to track that index. Right.
Right.
Definitely, I mean, if you don't have systems, if you are not able to track it properly, it will be difficult for an individual to replicate continuous and very close to index. Yes, he'll be able to buy those stocks, but the performance will not be very close to the index.
So not something that an investor can do at home without incurring significant cost and
Yeah.
time.
Not only cost, if you want to buy, say, all 50 stocks, you will need a larger amount as well, right? Of say Nifty 50 or Sensex 30 stocks. Whereas
Right.
in mutual fund format, you'll be able to do it, say, 500 rupees or 5,000 rupees or even 100 rupees also being offered. So with that, you'll be able to replicate and own that particular entire index. And of course, cost efficiency is also there. Passive funds are low cost, so you again save on that as well.
So you spoke of something called tracking error. Could you help understand how do I, at this point, there are a lot of index funds available in the market across segments, right? How does one compare different sort of passive funds and pick up something for their portfolio?
Yeah, so I'll split it into two parts. One is how to pick up a particular index fund. Okay, not the index fund, and the second would be how to pick up a particular index. Okay, that's how I'll put it. Okay, now so the efficiency of index fund is definitely known by, of course, there's a cost involved. So you should also look at what is the expense ratio which is being charged, and that cost turns out to be something called tracking error. And I would like to add one more point here: tracking difference also. Okay, sometimes investors get confused about tracking error and tracking difference. What is that? I'll just explain simply that if you invested in a particular index or index, say first January 2023, okay, and 1st January 2024, what is the return of a particular index and what is a return of a particular index fund? That difference is called tracking difference. Okay, that is based because of the expense ratio, because of the execution cost, and any inefficiency which you got in, that shows the difference. Okay, so tracking difference is if you pick up two data points and compare returns, called tracking difference. Now, when you look at this tracking difference for 1 year on a day-to-day basis, so like 250 working days, when you do it, track this tracking difference on day-to-day basis and do standard deviation, okay, or look at the consistency. So tracking error is the consistency of tracking difference. So one should look at tracking difference also lower, and tracking error also should be lower. Sometimes you may have a tracking error lower, but tracking difference can be high. Okay, because of inefficiency. Right. So you look at both these points. That's how one can choose. So one is cost. Second is your tracking error and tracking difference. All three you should look at. Size actually do not matter because these are all replicable indices. Now, second part is index. Which index is suitable for me? And definitely it goes as per your risk appetite. What is your need exactly? How much do you understand? How much? What's your goal planning? All those things. To keep it simple, somebody who is coming for the first time may choose popular indices, which is based on large cap, right? And that actually these are very good entry points as well. When you don't know what to do, I think these are the great starting point, right? So you can pick up any index on large cap, right? As your risk appetite goes up, as you understand, yes, now I am looking at, I understand this space, I can now stay invested for a longer term, say 10 year, 15 year, 20 years, and I have a more risk appetite, then you can get into mid cap segment, you can get into small cap segment, right? And of course there are thematic and sector funds are also there, can be very risky if you were looking at a shorter term. Don't look at these funds just based on performance, okay, because sometimes the sector tends to do well and you invest, okay, but if you don't understand that my risk, I should stay for 10 years, okay, so you have to look at what is your risk appetite. Do I understand, okay, market well? What's my goal planning? My horizon is 5 year, 10 year, 20 years. So longer is the better. Okay, but not necessarily longer. I may be a 20-year investor. But tomorrow market falls and mid cap and small cap shows me some shock. I'm not able to take it. Right? Then mid cap, small caps are not for you. That you are
Right.
better off with a large cap kind of.
Right.
Okay, and of course there are now, to avoid confusion or to keep it more simple, you also have a broad base indices which includes large, mid, and small all put together. It's like called total market fund. Okay, or the broader market when they cover entire market, 90-95% of the market, where you can buy the entire market, so you don't have to worry about anything. Am I losing out anything? No, I have a large cap also, I have a mid cap also, I have a small cap also.
Right.
That's how one can look at it.
So, and the, of course, the proportion in which your fund will be distributed will be on the basis of their relative market cap within the respective index. Let's say a Nifty 50 or a Sensex 30. The cost can be, or mostly the cost is below 20 basis points or 0.2%. So, how, why is the cost difference so high? Am I getting a lower quality product that the cost is lesser? So it's just out of, sort of trying to understand why is the cost lower?
Yeah, absolutely. I think this is what I begin with. So there is an active management. Okay, so there is a dedicated active team. Fund manager. There is an analyst. Okay, they have to do a lot of research. Okay, before building a portfolio, right? And the whole objective of that strategy is to outperform to a particular benchmark, maybe say Nifty 50, Nifty 100, whatever benchmark is there, right? So why you go to an active fund? To look at an additional return over the market. Now, when you come to a index fund, passive fund strategy, there is no active fund manager. You select a particular index based on the mandate given to you by an index, say Nifty or Sensex, whatever NSE or BSE indices. So whatever is the mandate, these are the stocks in the same weightages you should have, and we just replicate. So there is no research which is involved. There is no analyst which is required. You don't need to meet companies and find out which stocks to do it and all. Just replicate. Okay, so replication and there is no further research that reduces a lot of your cost. Fund manager is only for execution. You have to make sure that there are 50 stocks in the same weightages, all the corporate actions are done, okay, all the rebalancing is done properly. That is his job, right? So that saves a lot of cost for the investor. Okay, but that's one part. But second part also, we should also look at what is that you're buying. An active fund manager, if I am, say, Neelabh is a fund manager, right? I am just betting on Neelabh and his company to identify a particular portfolio for me which will do better than the market, right? Here, what are we trying to do? Here we are betting on, there are a lot of fund managers like Neelabh in the market, like say 1,500, 2,000 fund managers, and including all corporate treasuries, all the were market participants, and they decide where market is moving, right? So you are betting on the entire market wisdom. Right. I give this example, often that if you look at 10th board result, right? You see there are some students who fail, but there are some students actually come in merit as well, right? Now take this classroom to IIT classroom. What would you see? You'll observe that the first guy will be 98, 99%, but the last guy wouldn't be below 90% also, right? Because market has matured. And every semester you will see, the winner will keep changing. So here you're betting on that IIT classroom to build a portfolio for me, and you're not choosing one fund manager out of it. That's the passive approach, to keep it simple. Yeah.
Very interesting that the examples that you use to describe passive, but the point well made that it's basically market wisdom and which is embedded in the price, and therefore sort of the weightages of the portfolio, etc. These are determined automatically and not dependent on an individual fund manager or a particular investment style, and therefore the cost naturally is lower because all of that wisdom is sort of outsourced. Could you take an example of a portfolio and to help us understand what kind of investors are index funds / passive funds suitable for?
Right. Yeah, so passive fund is suitable for every investor portfolio. Okay, like I'm just out of college and I want to build my portfolio. I don't understand anything, right? The best thing is when you don't understand anything, just pick up passive. Just pick up an index fund, start your investment journey. Right? You don't have to choose from the list of fund, which have done better or look at performance. So no research is required for an investor also. You just pick up a broad base index and start your journey. Now I am getting used to, and there are a lot of options also available, right? You have a different caps available, market caps, you have a thematic India sector funds. So options are many options are available. As my risk appetite, as my journey experience goes, I can build my portfolio using these. I'm a pro investor. Okay, I'm pure active investors, and I look at only stocks. I look at very high performing stocks. I look at high risk strategies. For such investors also, passive
Hmm.
becomes a good point because it can become part of their core portfolio.
Right.
Right. When you have a passive as your core portfolio and satellite as an active strategy, what happens overall? What happens? Your overall cost comes down. Okay, for the
Right.
portfolio,
Right.
and overall underperformance also goes down because you're not dependent on those strategies which may do or may not do well. But when
Right.
market is also with you, so your overall underperformance goes down, your performance overall increases, improves, overall cost comes down, overall risk also comes down. So that's how it's actually suitable for everyone. Okay, as your risk appetite goes, there are different levels of funds and strategies available also in the passive. So it's a must portfolio in every client's portfolio to reduce his overall cost and have a better investment experience in the mutual fund market. Though there are a lot of options available in the market on the passive side. So what has happened, like large cap space used to be like 80% of the market, say 20 years ago. Right now that space is reducing because you see the other caps are also started doing well, right? And then investors tend to get it. I should also be in mid caps have done fantastic, small caps have done fantastic. I should be adding in the portfolio, and then also they get into sometimes dilemma whether how should I do it, right? So there are broad based market indices also available, like kind of 500, okay, or slightly bigger than that as well, right? Which actually simplifies any investor portfolio, for a choice, right? So he gets kind of a multi-cap portfolio, and again, it's some index fund, okay, better cap coverage, better stock, better market coverage. So your options also can be reduced by selecting such strategies which can answer you. Just it's like a one thali serves your entire purpose. Options also available. And as your experience and appetite grows, you have multiple options you can always choose in both active as well as passive.
Right. So, whether you are an experienced investor or somebody who's just starting out to invest, you will find something or the other in the passive space which suits your risk profile, and of course, that underlining that is important, that it needs to match with your risk profile. And then by using the index fund as a vehicle, you can start by investing as low as 100 rupees, 500 rupees, or whatever the case may be, and whichever segment you want to take exposure to. As you develop your knowledge vintage, and if you are willing to spend time, then you can move to taking calls on whether you want to add active funds to your portfolio, or you want to go into active stocks also yourself. uh, but so this is a great starting point, and it can sort of continue to be the anchor of your portfolio throughout your investment journey.
Absolutely, absolutely.
Great uh, great so I think is I've covered most of what sort of I wanted to cover, and some of the insights that you shared with us. uh, I hope that folks who are listening in to this conversation, they are able to take away from this. And if there are any questions from any of the investors, any of viewers of this insight edition of Insights, we'll reach out to you, and so that we can sort of close that loop. Um,
Sure.
Thank you so much for taking out this time, Vikash. It was great to speak with you.
So thank you, Neelabh. It was great interacting with you. Thank you for having me here.
Investment in securities market are subject to market risk. Read all the related documents carefully before investing. For more information, visit kuvera.in.